Alrighty, welcome back to the second half of the Smart Investing Show. And this is when we talk about financial planning with our financial planner, CFP Harrison Johnson. Harrison, glad you're here.
Glad to be here.
Talking about best accounts for kids and grandkids. Are we talking about giving kids money? I don't believe in that. I think the kids need to work for it. Go out, cut the grass, do these things. Come on.
So this is a question that I get from people. Oh, I have a grandson. I want to, start an account for them, or, I want to set something up for my kid. So it's something that I get asked fairly often. So I wanted to address it, and then we can also talk about the merit of whether you should do that at all. But a couple different accounts that you have options are, so there's 529 plans, there's custodial Roth IRAs, there's these newer Trump accounts, there's custodial brokerage accounts, the UTMAs or UGMAs, or there's just, having money in your name and then, gifting it to kids if that's something that you decide to do. So with a 529 account, money grows tax-free if you use it for education, but if you make a withdrawal that's not for education, you have taxes and penalties on the federal and state level on the earnings portion of what's in that plan. Now, there's a relatively newer rule where you can roll some of that money into a Roth IRA without federal taxes and penalties, but many states still will tax and penalize that. So state of California will tax and penalize you on the earnings if you do that Roth IRA deal with the 529 plans. Roth IRAs, so you can open up a custodial Roth for a child, but you can't make a contribution for them, or they can't make a contribution either if they don't have earned income, which most young kids don't have a job. So that's something that a lot of people just can't do. The Trump accounts that's relatively newer, they function essentially like a after-tax traditional IRA. So money is contributed to them after tax, and then the earnings grow tax-deferred, but when withdrawn, the earnings portion is taxable at ordinary income rates. So with those accounts, the kids can't touch the money until 18, and then at 18, they can, but they still have a penalty until they're 59 and a half. So it's kind of like a retirement account, but there are better retirement accounts, I think, because, again, with these accounts, it's funded with after-tax dollars, and then the earnings is also going to be taxable. Custodial accounts, those, are investment accounts, non-retirement investment accounts of the name of a child. The earnings, capital gains, dividends are taxable to the kid instead of you. However, the kiddie tax, what's called the kiddie tax, applies to that, which basically means a kid can have up to about $2,700 a year of investment income taxed at 0%. So although it's, reportable income, it's not a tax-deferred account. It kind of is because the income isn't actually taxed depending on how much they have. And then lastly, just accounts in the parent's name. And this is usually the one that we gravitate toward because it gives the parents or grandparents control of that money. The downside is if they have any earnings of that, capital gains, dividends, interest, that's taxable to the parents or grandparents, but it makes sure that they can help the kids, when they want, how they want, and because a lot of these other accounts, once the accounts belong to the kids, they can really do what they want with it without, that much control.
And I did want to say, we've talked about the Trump accounts before, and people have, I'm going to say, rightly corrected us, but we just didn't really talk about it. The strategy behind the Trump accounts, if you do fund them, is when that kid turns 18, you can do a Roth conversion, and the kid shouldn't have much income at 18. So there is a potential use case for it. But again, I want to circle back now to what Harrison brought up about keeping control of that account. That is why I do believe it's not the best thing to put money in your kids' accounts is when they turn 18. I hate to say it, we see it all the time where people, they just burn through it. I mean, we've seen people burn through $100,000 in a year when they had no business burning through $100,000. And frankly, the parent gives the money to that kid. As the kid being our client, we can't tell the parent, yeah, your kid burned through $100,000. It's like, no, you got to ask your kid what's going on with the account. It's not in your name.
And I guess that's why I'm a little bit, a little bit concerned on it, a little bit timid on it, where I think if you don't earn something, work for something, you don't appreciate it. And I've seen people get, and especially now, timid, we manage about $800 million, about 3,000 clients, I guess, but 2,000 accounts. So we've seen things that it's just human nature. You're 18 years old. You really have not developed any, and not all kids. There's some kids out there, 18, that are great kids, but other kids like, wow, I got $20,000. I'm rich. I can do whatever I want. I don't need to work. I got 20, and it's just such a shame And that's why I like accounts. I did that for you and all my kids was I kept control of the money. So if you want something, we'll take care of it. But I really made all 4 of you work for things, not just give you something.
Yeah, and I mean, Chase, you have 2 daughters. I'm about to have a son in about a month and a half. So, I mean, I'm not planning on opening up any special accounts for them. 529, I'm not going to do that. Trump accounts, I'll take the $1,000, but that's coming. But I'm
sit
not
there for
gonna,
18 years.
I'm not. Yeah, I know it's something that I just have to watch for forever. But my plan with my kids is going to be, I'll fund my own accounts, and then I'll see how hopefully I can be a good parent and help them out and everything. But I think the control of being able to help at the right time in the right amount for the right things is extremely valuable. And a lot of people discount that. They look at, oh, well, I want to use this custodial account because it's for them, it's in their name. But again, once you make that contribution to that 1-year-old, it's really their money. And then at 18, the account belongs to them. So if they want to go, do something else with it, that you can't really.
Yeah, they want to go buy a new Corvette. Hey, thanks, Dad. I appreciate the new Corvette. Like, no, that's not what that was for.
Right.
And I think the other problem is a lot of these accounts, they do come with tax benefits. So you are foregoing some tax benefits in the name of control, but a lot of people don't utilize the accounts right anyway. So the tax benefit over 18 years might amount to be, and I'm just going to throw out a number here, like $2,000.
Right.
To me, over 18 years, losing out on $2,000 of tax benefits is far worth it to keep control of the money and being able to disperse it when the time comes and when the kid is, I think, deserving of it.
Yeah. I mean, if you fund an account in your name, and that's also not talking about, like, if you're not maxing out your own retirement accounts, that's something that you want to be doing before you're doing anything for your kids, because your own retirement accounts are going to be more tax efficient and less restrictive than anything for them. But if you are doing that and you put money into a taxable account, a brokerage account, capital gain and dividend taxation is flexible. You can choose when you want to sell. You can realize how much you want to realize. The tax rates are less than ordinary income. So it's not as if you're paying a whole lot more, giving up that control.
And I think, if you tell a kid, maybe once they turn 20 or 30, I took care of you during your infancy to when you were 18 by giving you money and foregoing my retirement. So when I retire, you need to take care of me. I think most 20, 30 years would be like, no, why'd you do that?
I've got a mortgage. I've got a kid. I can't take care of you. You can come live with us, but you live in the closet.
It's like, I gave you money, now you got to give it back. It's like, why didn't you just give it to yourself?
And I guess the important thing is here is that whatever people want to do, there are ways to put money away for kids, and it depends on what you're doing. And the thing I will say too, and then we'll wrap it up, is that you don't know how a 1-year-old is going to turn out 18 years from now. Mm-hmm. That's the big guess. And
hopefully they have high hopes. Yes,
we have high hopes. Hope for the best. But sometimes things, they get around the wrong friends or whatever, and they go through a difficult time. And then by the time they're 30, they wake up. Yeah. By that time, money's gone. So, but again, options for people.
There are options. Yep. All these accounts are different. Sometimes they work, in different situations. But that's what I wanted to bring up.
Great. Well, Harrison, thank you very much. We appreciate it. Again, that is Harrison Johnson. He's a CFP. He's the financial planner for Wilsey Asset Management. If you want to contact him, give him a call at the office, 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com.